Chapter 11 discusses a concept called centralization and decentralization. This is also discussed in the context of what we call segment reporting. If we think about traditional management organization, it can be viewed in a pyramid structure. There is one point, and then it widens out as it goes to the base. That pyramid represents the organization of management within a company. There can only be one top manager, the CEO, the president, call it what you may. And at the very bottom, since it's much wider, we have several employees. We think of these as what we call line employees. They're doing most of the day-to-day work, whereas the top manager is making the strategic and long-term decision-making. In the middle, though, is various layers of management. This is going to depend upon the size and nature of the business. For example, let's say that you have a small lawn care business. All you need is a lawnmower, yourself, and clients. You can feasibly make all the decisions for this business. You can do all the work for this business, and you don't need anyone else providing any form of instruction, guidance, or management for you. Very simple. This is not true, though, of the vast majority of businesses. They're quite larger than a small lawn care business. Just consider a fast food restaurant, for example. These tend to be open for long hours, if not some 24 hours every day of the week, with very little interruptions of that for, say, Christmas or even New Year's Day. A lot of fast food restaurants just don't ever seem to close. So if this is your business and you are going to be operating very extended hours, there is no way that you would be possible to run that business all by yourself. Your physical limitations of just your body are going to not make this permissible. So instead, you will hire someone to assist you. You may have an assistant manager, so that if you work the day shift, the assistant manager may work the night shift. Or we can think of it like again, just pick a regular kind of store venture, and let's say that you're open just the traditional Monday through Friday from 8 to 5 o'clock. It's feasible that you could run that business and make every decision for it. However, let's say your business has become quite successful and you decide you want to expand. So you build a second store in a different part of town. It will again be physically impossible for you to make all the decisions in that business. You cannot be in two places at once. So what you do is hire again another manager to run that other business. We understand this, but it goes a little bit beyond what you may be thinking. When you hire a manager, you hire that individual to represent the best ideals for that corporation, or stated differently, you want to hire someone who will agree to support your strategic direction and goals. So you are willing to delegate authority to another individual to help make the business operate much more efficiently and effectively. This concept is called decentralization. Some companies have greater degrees of this than others. Some individuals like to be more in control, but this is not going to be feasible as the company grows or becomes more complex in nature. So decentralization is pretty much a must. It just depends upon how many layers of management do you want to decentralize your authority. So what are some benefits? Well, you can see on the screen that it does allow management to concentrate on the strategy, the higher level decision making, instead of the day-to-day kind of mundane decisions. It also provides lower level managers with experience in making certain decisions. In other words, it could be grooming them to make those more strategic, focused decisions. Number 3, increased job satisfaction. We all know that if you are made to be felt as part of a team, that you're probably happier with your job, you enjoy that job, you have a vested interest in that job, and all of these, well, basically a happy employee means a better functioning business. The decisions at the lower level, even though they may be day-to-day or what we may call a mundane decision, those individuals who are actually doing those tasks probably know more about the functions and what is necessary at that task than, say, a top-level manager. So the decisions could oftentimes be better when someone at a lower level makes them. And then since we delegate authority, it allows me to assess performance. We're going to look at some ways that we can assess performance in the context of Chapter 11. There are some disadvantages, however. Lower level managers may not make best decisions for the whole company. We saw this in budgeting. There tends to be a lot of behavioral problems with self-interest. We're going to make a decision that'll best affect me and my position. And so we need to be careful for that. You could have lack of coordination. In other words, there's too many layers of managers and they just can't all come together, or the communication can be poor. Lower level managers may see the company going in a different direction than the entire organization, and of course may bias or result in what we call sub-optimization of decision making. And sometimes it may be difficult to spread ideas because you've got to send this through multiple layers of management, and it may get filtered, lost along the way, or rejected. When we do decentralize, it creates what is called responsibility centers. And there are 4 basic kinds. The first one is called a cost center. In a cost center, a manager is only responsible for costs. For years, I've always had an office wherever I have been working, and I'm sure some of you can also relate to this. And every morning when I have come into my office, my trash can has been emptied. Sometimes the floor has been vacuumed, the windows are clean, my desk may have been dusted. I didn't do this, obviously. I'm sure that there was no secret little fairy that came in and did it. It was housekeeping, janitors, custodians, whatever you want to call them. But in all of those years, I have never seen a bill on my desk that said, "We were in your office for 30 minutes cleaning. Our rates are X dollars an hour. Therefore, you owe me a certain amount of money." No, I have never seen this. This concept of cost centers means that managers incur costs in performing those operations, but they make absolutely no revenue to support those costs. Janitorial service is one example, but there are many. For example, what about human resources? Payroll. These also incur costs, but they make absolutely no money. The objective, therefore, is to make sure that you keep your costs under control. So let's go back to my janitorial example. Suppose you have 2 candidates for the job in the janitorial department. One has just graduated from high school, A second just graduated from MIT with an advanced graduate degree. Which one are you going to hire? Well, obviously, I'm going to go with the high school graduate because it will cost me less. That MIT graduate is going to command a higher salary, and that is not going to control my costs. In the context of performing our janitorial services, we also are going to need some supplies for cleaning, and we could go out and buy the most expensive name brands, or we can buy a generic brand that will clean just as well, but costs significantly less. This is the objective of a cost center. Minimize your costs. The second type of responsibility is called a revenue center. These are theoretical. There is no such thing as a pure revenue center. I can give you examples of some that approach it but never quite achieve it. But the whole idea is the manager is only responsible for making revenue but no cost. If you've ever been driving down a toll road, you know that at some point in time you are going to have to pay some money. I understand that the toll booths, the actual structure, did cost a significant amount to construct, put in service. It does require a little bit of electricity to raise and lower the arms and count the coins as you throw that into the collection bin. And we may have one employee sitting over at the edge to make change or to catch any violators that proceed through the toll booth without paying. Well, the actual construction costs are going to be recouped relatively quickly. After all, people are just throwing money at them all day long. They will be covered, leaving just the basic operating costs, electricity, and that individual sitting over at the side. So the costs are absolutely minimal compared to the amount of revenue that is bringing in. This would technically be considered a revenue center, even though it does incur some very minimal costs. A second example would be a fines department in a library. All we need is someone there collecting the money where people owe. But, think about it again, I have to pay somebody to collect it. There will always be a cost involved whenever revenue is earned. It is just a fact. So theoretically, revenue centers exist, practically not in the purest form. Instead, what we talk about is what we call a profit center. And this is where a manager has control over both costs and revenues. So we want to know, are you being profitable? When we first started talking about budgeting, I broke down the example to where we would have a men's wear, women's wear, children's wear, houseware departments. Each of these departments represent profit centers. The manager in those areas are responsible for making sales, revenue, but they are also responsible for the costs they incur, for the inventory, for the salaries and wages, for the occupancy cost that is allocated, the electricity, utilities. This is what a profit center is. An investment center, which is the fourth, is when a manager is concerned with both costs and revenues, as well as the actual investment in the operating assets themselves. So going back to my department store again, the individual departments are profit centers, but the entire store is what we call an investment center. Not only do we have to make enough profits within each area, we have to make enough profits for the store overall to support the building itself. And if we don't make enough money to cover that, then we will probably abandon that. We've seen shopping malls come and go. Think about Hickory Hollow Mall. Used to be quite a bustling center several years ago, but then it slowly died. As the business from customers declined, the large anchor department stores were not making enough money to sustain those substantial square footage of buildings. As a result, they left. This is not to say that they were not making profits on selling shirts, pants, shoes. They were, but they were not making enough to cover the asset itself in which it operated, the investment center. It is the investment center that gets most of the focus, since it's the most important, of course. Different ways in which we can assess these is breaking things down into what we call segment reporting. Segment reporting for like a department store would show the overall store, but would break down the different departments and show what is happening in menswear, women's wear, children's wear, etc. But this could also be taken up to a larger scale, such as the Middle Tennessee area. We could have a Nashville, Green Hills, Macy's, a Nashville area, Cool Springs, Macy's. We could have a Nashville area Rivergate Mall, Macy's, and so on. So each of those would be segments within the actual Nashville area. And we could keep going up. We could say the Southeast area. What is in Tennessee? What is in Georgia? What is in Alabama? And so on. And of course, all of these would roll back to the corporate headquarters, which would be up in New York City. When we do segment reporting, we have to distinguish certain costs. Obviously, if we're looking at, for example, the individual profit centers within an investment center, it's easy to attribute the menswear cost to the menswear department in terms of the inventory. Those are more like the variable cost. The fixed costs, however, are the sticking points, and we've seen this all throughout this class. We have what are called traceable fixed costs, and these are costs that are incurred directly to a particular segment only. For example, the manager of the menswear would be traceable to that segment, or the manager of the Green Hills Macy's is directly traceable to that store. Common fixed costs, on the other hand, these support various areas. The manager of the Green Hills Macy's is a common cost for menswear, women's wear, children's wear, and housewares. Corporate costs of administrators and top managers are common for the Tennessee geographic area, to the Georgia geographic area, and so on. So depending upon what you are defining, traceable and common can be customized as necessary. The traceable ones are always within the direct control of the individual. And remember, the controllability principle we have previously discussed says only things that you can control should be what the manager is held responsible for when it comes to doing assessments. Common costs are beyond your control. Yes, you must contribute to paying those, but you cannot change it. Imagine how absurd it would be for, say, a manager of the Cool Springs Macy's call up to New York City and say, well, we're not going to pay the president as much salary anymore, so we're going to cut that. It would never work. the president's salary is allocated to all the other stores, and the stores just have to absorb it. These are common fixed costs, but you're not held responsible for them for assessment purposes because you cannot control them. They do affect your overall profitability, however. That's a given. What we will do when we do segment reporting is do an intermediate level of profitability, and we call this segment margin. It is synonymous in one regard to contribution margin, but it also factors in those directly traceable fixed costs. So it's just one step beyond contribution margin. And it is the best gauge for long-term profitability for any given segment. Once we consider segment margin, we can also look at it from a ratio perspective. We can do what is called return on investment. You may have heard of this ratio previously. It is a classic finance ratio. It basically is calculated in the following manner. Take the income you earn from that segment and divide by the average operating assets that were invested in that segment. It basically tells you what kind of percentage you have achieved on those assets. Please note that when we talk about operating income, this is generally income that is before interest and taxes. Interest and taxes, they are not controllable per se, but they are artifacts because of prior decisions that were made, such as if I borrow money, interest is a direct impact after that. So I'm really not controlling the interest, you control the level of debt. And if I make profits, you're going to pay taxes. I can't really control taxes without saying I'm not going to make any profits or not as much. So these two are just the follow-through of previous decisions, and so we exclude them. And of course, the operating assets are those that are productively being used for that segment, that organization. Now, one thing that has evolved over time is, and we've seen this previously, that it's nice to have a piece of information to where we can analyze it, but it's even better if we can break that information down into finer pieces, whether that is a plant-wide overhead rate to activity-based costing, whether it was like the overall overhead variance and we broke it down into the variable and fixed spending and efficiency variances. The finer information helps me make better decisions. So the ROI calculation was broken down. It basically performed a little algebraic trick. We're going to multiply the classical ROI up here, and we are going to take 1 with the multiplication. And that 1 is going to be defined as sales over sales. In other words, we're going to split the ROI calculation. You can see income is on one side, and then we're going to pull the assets on the other, and then we're just going to put 1 as defined by sales over sales. And of course, if you cross multiply, this will eventually condense right back down to the original formula. This breakdown here allows me to assess profitability in terms of what we call margin, which is a direct profit measure, and turnover, which is a measure of efficiency. This is called a DuPont analysis. And yes, it was originated by the DuPont company. This allows me the ability to assess not only how profitable we are, but again, how efficient we are using those assets to make those profits. And then a final way in which we can assess operations is something called residual income. Residual income basically says let's look at your expectation of what you have to have at a minimum for your operations to be sustainable. And of course we call this our minimum required rate of return. You can think of it like a hurdle rate, a burden, a cost of capital that you have to have. It is just a given amount that you must have in order to be profitable. You're going to take that return and say, well, let's compare that to the operating assets. If you take the return and apply it to those operating assets, it will give you an expected amount of profits that you have to have at a minimum. We will then compare that to what you actually earned. And if there's a difference, we call that residual income. In other words, you made more profit than you thought you were going to make, which is always a great result. Now, there are various reasons why we would use ROI, residual income. And by the way, these are not the only ways in which we can assess operations. These are just some of the classic ones. What I want us to do next is look at a few examples putting these into practice.